All right, so Wall Street just gave us one of the biggest head scratchers of the earnings season. We're talking about Zscaler, a huge name in cybersecurity. They dropped a fantastic earnings report. I mean, really stellar numbers. And what happened? The stock absolutely plummeted. It makes no sense. Or does it? Today, we're going to figure it out. Okay, so just look at this. On one side, you've got nothing but good news. Revenue hit a whopping $816 million. That's up 26% from last year. And they're hitting what's called the Rule of 62. That's an elite performance metric for software companies. It's a sign of a really, really healthy business. But then you look at the other side, and bam, the market just hammers the stock, sending it down 10% after the bell. It just doesn't add up. And that brings us to the big question, right? How on earth does this happen? How can a company that seems to be firing on all cylinders trigger such a massive negative reaction? Well, the answer isn't in those big, splashy headlines. It's buried in the details, the stuff the pros and their trading algorithms were looking at. And that's exactly where we're going next. All right, let's start unpacking this mystery. Our first big clue has everything to do with the quality of Zscaler's growth. Because, and this is super important on Wall Street, not all growth is created equal. The market saw something under the hood here. And yeah, it made them really, really nervous. So, to get this, we've got to quickly talk about a key metric called ARR. It stands for Annual Recurring Revenue. Since Zscaler is all about subscriptions, this number is pretty much everything. It's the predictable, locked-in cash they can count on for the year. You can think of it as the very heartbeat of the company. And at first glance, their ARR looked incredible. They reported total ARR growth of 25%, getting them to a massive $3.4 billion. I mean, come on, that's a number that should have investors popping champagne, right? A fantastic result. But, and you knew there was a but coming, this is where the plot thickens. See, the people really moving the markets, we're talking those super fast trading algorithms and the big shot Wall Street analysts, they don't just look at the cover of the book, they rip it open and read the fine print, instantly. And here it is. This is what they found. When you strip out the growth Zscaler got from buying other companies and you just look at their core organic growth, well, it actually slowed down. It went from 22% last quarter to 21% this time. Now, that might not sound like a huge drop, but for a high-flying tech stock that's valued for its incredible growth, any slowdown at all is a huge, flashing red light. And this chart shows you exactly how it happened. A big chunk of that impressive new revenue wasn't from selling more of their own stuff. It came from buying another company called Red Canary. So from the market's point of view, Zscaler didn't really earn this great quarter, they bought it. And that's a world of difference. Okay, so that was clue number one, the slowing organic growth that was hidden by an acquisition. Now for clue number two, which is just as alarming for investors, it's getting way, way more expensive for Zscaler to achieve its growth. So, real quick, a tiny bit of accounting. I know, but it's crucial here. There's GAAP, which is the official, strict rulebook for how companies report their finances. And then there's non-GAAP, which is the company's own adjusted version, where they can exclude certain costs, like the stock they give to employees, to paint a prettier picture. And this is where you see two totally different stories being told. Using their preferred non-GAAP number, Zscaler is saying, hey, look at us, we have a healthy 22% operating margin. But when you look at the official GAAP numbers, the story completely flips on its head. The company is actually losing a lot more money. This chart just drives the point home. Look at this. Last year, in the same quarter, they posted a net loss of about $7.7 million. This year, that loss absolutely exploded to over $34 million. That's more than 4 times higher. So you've got a double whammy, slowing core growth and skyrocketing losses. That's a toxic combination for any stock's valuation. All right, there's one more piece to this whole puzzle, and it's a big one. It's not just about Zscaler's numbers today. It's about a huge question mark hanging over their entire industry's future, and its name is AI. Now, to his credit, Zscaler CEO, Jay Chaudhry, he tackled this head on. He basically went on the offensive, saying, bring on the AI. His argument is that AI isn't a threat, it's actually their biggest opportunity. As companies dive headfirst into using all these new AI tools, he says they're going to need Zscaler more than ever to keep it all from going haywire. And that right there is the central debate that's now raging around the company's stock. Is this big pivot to AI security a brilliant move that's about to kick off a whole new cycle of massive growth? Or is it just a desperate defensive move to stop their core business from getting disrupted by newer, smarter AI-focused tools? Honestly, Wall Street is completely split. So let's pull all these clues together. When you do, you see two completely opposite stories that investors are wrestling with right now. This is the classic bull versus bear showdown for the future of Zscaler. So here's the bull case, the optimistic view. The bulls are saying, look, that Red Canary deal will work out great, the AI strategy is genius, and this 10% stock drop is a gift. It's time to buy. But the bears are on the other side, saying, no way. The core business is slowing down for good, those real losses are getting scary, and this stock is still way too expensive. It's got farther to fall. And that really leaves us with the ultimate question. Which story is the right one? Is this slowdown in the core business a fatal flaw that completely justifies the stock's crash? Or is the market just panicking and totally misjudging the massive opportunity Zscaler has to become the go-to security platform for the entire AI revolution? The answer to that is going to decide everything for this stock.